A surge in domestic inflation pushes back expectations of a rate cut in India, even as a surge in bond yields in the US stymies the Trump 2.0 rally. Realty, auto and industrials are the big drags, even as utilities manage some green.
Swiggy lists at a premium to its offer price of 390 rupees, delivering gains to IPO investors after not so strong subscription. Analysts, however, remain divided on the potential for gains from investing in the stock.
NTPC Green will launch its 10,000 crore IPO with an offer of shares in a 102 to 108 rupees band on November 19th. The offering will be the third largest IPO of the year after Hyundai and Swiggy.
Trump picks Elon Musk and Vivek Ramaswamy to lead the Department of Government Efficiency to drive efficiency in the government. But unlike the name suggests, the body will not be a government entity. Dogecoin jumps.
October CPI inflation comes in at a 14-month high of 6.2, pulled up largely by vegetables. Yields inch up a tad as hope of rate cuts and even some dovishness in the December vanish. Rupee takes a breather from its relentless fall since Trump's victory. Hello and welcome to Halftime Report. I'm Vivek Iyer and with me today is Mangalam Malu. Mangalam, it's been an action-packed session, but the main headline is the fact is that markets continue to see quite a bit of selling pressure. The line in the sand that we were discussing in the morning was 23,800, but that's been given up. Markets bounced back briefly twice from those levels, but even despite that, you're seeing quite a bit of selling pressure. Nifty just holding on to the 23,700 mark. Broad end of the market, the Nifty cap index, small cap index, and the Nifty bank, as you can see at the top of your screen, all of them too are seeing significant selling pressure.
It's a relentless sell-off that we're seeing in the frontline indices. You know, what's actually interesting is the way the Nifty bank has underperformed. You know, most part of today's trading session, if you pull up both the Nifty as well as the Nifty bank charts right on your screen, you would see that the Nifty bank was attempting to outperform and support the frontline index, but now that too has thrown in the towel. The Nifty bank is now down almost 0.9%, with the Nifty down about 0.7%. For most part of today's first half of trade, the Nifty bank was outperforming the Nifty, and now it's underperforming that. And the pain in the broader market, you know, the more we speak about it, the less it is, because we have now 2,100 stocks on the NSE which are in the red, for about 300 which are in the green. So we'll keep an eye out on those crisscross lines which are neither crossing nor crossing. A wide gap between the red and the green lines is what we'll see today. But amidst all of those stocks, the one that really stands out, and it's perhaps the story of the day on account of the listing, is Swiggy. You have to give it to the pricing of the company at a steep discount to Zomato. The street thought that maybe, because of the tepid listing and the tepid, subscription and the market scenario itself, there could be a bit of a discount, but no. Right. What this stock has done is it's opened in the green, and from there on itself, because of its lack of subscription, there is a case for FOMO, and a lot of investors now perhaps getting in. The gap between Zomato and Swiggy right now is at around 55% when it comes to the market cap itself. So that's something we will most definitely closely monitor. Given the metrics, obviously Swiggy has to trade at a discount to Zomato, but at what is the discount is something that we'll always keep watching out for as the water finds its own level. Most important part, the investors who are making money on Swiggy right now, one of them is Accel. Accel started accumulating Swiggy shares from 2015 itself, and their weighted average acquisition price is close to around 11.17 rupees per share. In the IPO, the offer for sale, they offloaded about 1.05 crore shares at a price of 390, which was the issue price itself, sitting on a fair amount of gains. The question again, when it comes to growth expectations from Swiggy, what as per them is the fair value and the discount that it should be trading at versus Zomato. We have the man himself, Anand Daniel, partner at Accel, joins us now. Just to give you a perspective, they sold about 1.05 crore shares, which is about 0.5% equity, but as per their current shareholding, they still have about 5.5% stake in the company. Anand, congratulations on this stellar investment for you and a great exit for just a little bit of the overall holdings that you have in Swiggy as well. Over 30 times the gains that you've made. Just wanted to understand, what as per you should be the fair value of Swiggy as compared to Zomato when it comes to a discount, and what do you do with the remaining 5.58% stake? How long do you intend to hold it for?
Hi. Thanks for having me. It's been a real pleasure. So we started investing, as you pointed out, in Swiggy in 2015. Our initial investment was at a $6 million post. So from that, it's been an amazing journey. To your question, I think in India, Harsha talked about it, is at a very early stage of evolution when it comes to food and retail and commerce. So it's a fundamentally very strong company. So we are excited about what has happened in the last decade, and we believe that it's a very strong company and will continue to grow and scale.
No, there's no denying that it is a strong company. The question is, how much is in the price already when it comes to its other listed peer? Because now you have a comparable, right? And you have comparable metrics as well for both the food delivery and the quick commerce space. What, according to you, is should be the fair discount to the other listed player? And at the same time, if you could give us a sense of what the challenges in growth for Swiggy would be from here on.
Got it. I think the discount is the market's going to decide that, right? So it's already thinking through that and working through that. And as we look forward to your question on what are the challenges, I think it's a very operationally intense business, as you can imagine, being in hundreds of cities. Anything can change in a moment's notice across this. So keeping the ship running as a tight journey, they've done a good job, but Swiggy needs to continue doing that, and Harsha and the management team are very well placed to do that going forward as well.
Good afternoon, Anand. Thank you so much for joining us. First up, the key question is, you've offloaded a very tiny part of the stake. You still hold well over 5%. So number one, do you continue to hold on to that, or will you be looking to offload that at regular intervals? Do you have a path over there? And secondly, one of the reasons why the IPO was not subscribed as much as other IPOs that we saw during the course of the year was the fact that investors are still worried about the actual path to profitability. So what is your take over there? When do you see especially companies like Swiggy actually turning bottom line profitable?
I think Swiggy has given the guidance themselves. They've been working towards it on a steady pace, right? So on the path to profitability, and I think they have a very well thought through plan there. What was the other question? Sorry, I missed the first question.
What do you do with your remainder of the stake? You have close to 5.5% stake there.
Oh yeah, that's right. So we are pretty excited. We've got, as you pointed out, reasonable liquidity. And I think the prospects of the company are very good. And as you know, there's a lockup period. But overall, we are very excited about the prospects of the company. And as of now, the plan is to hold.
All right. As of now, the plan is to hold. But, it's also limited by the life of your fund, right? When does that end? If you could give us a rough timeline.
Yeah, the funds are roughly 10 to 13 years, and there's no hard deadline by this time you have to close or anything like that. So for good companies, we tend to hold on. For example, Flipkart initial investment was 2008, and we exited that completely only very recently. So it was more than 15 years that we had.
All right. Two-part question, both of them related. One, what is your growth expectation from Swiggy from here on? Street is expecting the industry to grow anywhere between 32 to 35%. And in a market where, it is almost a duopoly with some more share for Zomato than Swiggy, what do you think is Swiggy's right to win here? And do, both players in the industry grow at the same rate?
Yeah, so there's food and there's retail, grocery, and broader retail. On the food side, as we all know, it's stabilized and growing at a reasonable pace there. And if you look at retail overall, of the 700 billion plus, India is still very early in the online penetration, and particularly quick commerce is even earlier. And it's about each company executing against its plan and growing. And the market is so large. Harsha has talked about it to the media as well. It's more how do consumers come more and more online, realize, taste the quick commerce experience, and then order more. So growth potential is much higher on the retail side.
Okay, thank you so much, Daniel, for joining us, and congratulations on what's been a very successful investment for you. But moving on, let's slip into a short break. Up next, we will be joined by Navin Killa, the head of APAC Telecommunications at UBS Securities, to discuss trends in the telecom industry. Stay tuned. Welcome back to a halftime report. Well, the selling pressure on the Nifty as well as the markets has only intensified. Nifty has now given up the 23,700 mark as well. But moving on, let's move our focus to the telecom industry. From tariff hikes to AGR issues and the latest satellite spectrum growth, the sector has been in news lately. We are now joined by Navin Killa, the head of APAC Telecommunications at UBS Securities, from the sidelines of the UBS India Summit 2024. Good afternoon, Navin. Thank you so much for joining us. Well, there's so much happening as far as the telecom space in India is concerned. Do you think, number one, that this space can continue to remain at least a three-player market? Vodafone Idea has seen significant price erosion too.
Yeah, thank you very much for having me, actually. So look, I mean, if you go in theory, we actually have 4 operators in the market today, right, including BSNL. I think obviously the government has stated that they would like to have 3 private players at the very least, and then possibly for BSNL to continue. And we have seen initiatives taken from the government in the past around AGR and spectrum payment deferrals that have allowed for that to happen. I do think a very important milestone will be around next year or maybe a little bit before that, because a lot of the moratorium periods come to an end between June to December 2025. And I think we would probably expect the government to take more steps to support Vodafone Idea. I think the base case that we have, and which we think industry has, is that there will probably be more deferrals, maybe more equitization. Our view is that maybe more would be required, including potential cancellation or even waiver of some of those dues, which is not that easy to execute, but we think in the interest of the industry, maybe there are ways that can be done. But again, like I said, June 2025 or right before that is the time frame when we would expect the government to take some action on that front.
Right. From an investable standpoint, you said while in theory there are 4 stocks, from an investable standpoint, that leaves one with just about 2.5 if one was to look at Vodafone as that half. I wanted your thoughts on how does one play it? Do you go with a pure play telecom player? Do you go with the conglomerate where the hope is that at some point there will be a demerger? Or do you back the half chance there? I ask this because, everyone's hoping for some sort of tariff hikes to come by as well. If you could give us a sense on, how does one play this from an investment standpoint, even as the macros for the telecom sector hold up the population, increasing data consumption, cheapest cost of data, etc.?
Yeah. So look, I'll make 3 points. First of all, if you look at telecom sector globally, generally there is a tendency for stocks within the same country to have very strong correlation. So when a sector is in a price repair mode, growth mode, profitability mode, tendency is for all stocks to do well. And then similarly, when we are entering a period of competition or regulatory uncertainty, then there is a good chance for the whole sector to underperform. So there is generally a very strong amount of correlation that all telecom stocks within a single market tend to have. Now, that being said, obviously, as you rightly pointed out, in India, we have a bit of a unique situation in the sense that we have a pure play telco. We have a telco where there are balance sheet issues. And then, of course, we have got a conglomerate. Now, if you look at the point you made earlier about tariffs, so we have had 3 rounds of tariff increases in the last 4 years, 4.5 years. And essentially, if you look at India's mobile revenue as a percentage of GDP, it's actually now comparable to most other emerging markets, maybe about 10% lower. So we think there is room for tariffs to continue to go up, but not probably at the same pace at which they have gone up in the last 3-4 years. We think it will be important for the operators, therefore, to start differentiating pricing because we have a very flat pricing structure right now. And so there is probably a need to create a range of pricing plans such that customers who have the ability to pay more, who want to consume more data, or who want more premium services like roaming, content, etc., are charged more. But at the same time, there is no across-the-board price increase for everybody in the ecosystem. And that's probably going to be the next phase that we would expect to continue. I think from a stock perspective, again,
right.
Yeah. Sorry,
please go ahead. Please go ahead.
No, I was just saying from a stock perspective, again, as I said before, generally there tends to be correlation among all stocks in the sector. But then, of course, here we have a unique situation in the sense that one of the operators is very sensitive to what the government does on the AGR. So the operating trends are probably less important to the whole equity value creation for that business. And that obviously makes it more of a play on the point I made earlier about what the government is going to do next year.
Right. Naveen, number one, talk to us about the ability of the consumer to actually absorb price hikes. In the last round of tariff price hikes you actually saw a little bit of down trading happening, and you actually saw people with 2 SIM cards, going ahead and migrating to 1 SIM card. That is the first question. Second question, what is the blue sky scenario as far as Vodafone Idea is concerned? What is the best that they can hope for in terms of regulatory relief coming in? Because the Supreme Court judgment has been quite clear. And we believe that, the last time, you had a report on Vodafone Idea, it actually upgraded it to a buy rating. Has there been any change in stance, from that particular view that you had then?
Right. So let me answer your first question on consumer ability to absorb, right? So look, the first tariff increase, which was done in December 2019, did result in significant churn. But that is also because at that time, we did have an inflated customer base because Reliance Jio had just entered the market, and there were a lot of double SIMs and triple SIMs even. We did notice that in the second and then in the recent tariff increase, the number or the magnitude of churn did decline. It's not zero, but the magnitude of churn has definitely come down. On the downgrade side as well, yes, there has been some, because if you look at the ARPU increase that the 3 operators have reported, or the 2 operators have reported so far, it is less than the percentage tariff increase that they implemented. I'd wait for 1 more quarter to come to a conclusion, but even then, there is definitely some downgrades. In fact, we had done a consumer survey right about the time when the tariff increase was implemented, and our conclusion back then was about 20 to 25% of customers were looking to downgrade, particularly from the 1.5 GB plan, which is the most common plan, to 1 GB per day. So there are downgrades, there is churn, and yet if you look at it on a total basis, the sector would have probably grown revenues 7-8% in the last quarter, and maybe another 5% in the next quarter. And so cumulatively, you would have seen 12-13% sector revenue growth. So, there is elasticity, but net, there is still a decent pass-through of the tariff increase in terms of sector revenues. Of course, at some point, as you rightly pointed out, you need to be careful because, after all, telecom is a product that is consumed by masses. And which is why the point I made earlier was that over time, telcos will have to think about changes in tariff structure, which are not across the board, but which only make the upper end of the market pay for premium services that could be offered. On your second question on Vodafone, look, I think if you look at the operating situation, they have positive operating cash flow, right? So if you look at EBITDA minus lease payments, they are generating operating cash flow. And with the capital raise that they have done, they also have at least the next 2 to 3 years of capex sorted out. There is a bank funding process which is going on. We don't know a lot of detail about that. But if that plays out, then that kind of sorts out another 1 to 2 years of capex. And I would believe if you look at the numbers, the capex and all that they've talked about, in 3 to 4 years, they should get to a fighting kind of 4G coverage. So I think from an operating perspective, the company has a plan in place. The challenge when it comes to the investability or any kind of view on the stock is the total amount of debt, large part of which is government debt, which then is a little bit difficult to value because you don't know when it will be paid, whether there will be deferrals, whether there will be cancellations, whether there will be equitization, if there is equitization, at what price. And so given all those uncertainties, I can imagine that the range of scenarios on the stock are quite substantial.
All right, let's keep it very simple then before we let you go, Naveen. Two-part question. One, in your model, given the explanations that you've given on account of, price hikes and the models that these companies would, perhaps undertake, what is the effective price hike that you've factored in over the next 3 years on a compounded basis in your model? That's point number one. And secondly, is there a way to play this theme via ancillaries and not just the listed telecom companies that we have? Pure play telecom companies, can we play it via telecom infra or ancillaries?
Sure. So on the price hike, so we have about high single-digit ARPU increase that translates to about 8-9% CAGR over the next 3 years. Not all of that is coming from price increase, by the way. Remember, there are secular factors: 2G to 4G migration, prepaid to postpaid migration, 1.5 GB customer migrating to 2 GB, and so on and so forth. So if you dissect, I would say that there's probably 5 to 6% annual price increase that we are building, and then maybe another 4% which is coming from these secular factors that I talked about. Now, obviously, it's not going to be annual 5-6% price increases. There's going to be a one-off. We don't know when, but at some point in the next 2 years.
Right.
So that's what essentially goes into our model. The sector revenue growth is a bit higher than that because remember there is some organic growth in the number of customers as well. So the sector revenue growth that we have is around 10 to 11%. So that's kind of what goes into our model. I think your second question was on ancillaries. So, I mean, the ancillary space in India, to be fair, is not that deep. I mean, we have the tower companies, we have a couple of fiber companies, a couple of infrastructure companies, but it's not as deep as you would have in a market like a US or a China, where the whole ecosystem is listed or playable in the equity markets. But I mean, on the tower companies, again, the challenge there is a lot of that is dependent on the Vodafone Idea viability. And I kind of talked about the puts and takes there. Right. The rest of the ecosystem, again, a lot of them are very small. But yeah, there are definitely some names that you can play there more as a capex interplay for the larger telcos. And I think, I guess the last point I would make there Naveen. Is we are seeing a shift in capex, which will help.
Very sorry, Naveen, to interrupt you, but we're running out of time. Moving on, thank you so much for joining us and sharing your thoughts on the telecom space. Well, moving on, CNBC-TV18 celebrates 25 years of excellence. We invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit on November 14, starting 10 a.m. onwards. A power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Only and only on CNBC-TV18.
You're watching us here on Halftime Report. Perfect time to get you the F&O update at midday itself as the sell-off for the frontline indices intensifies. The Nifty is now settling just under that 23,000 or around that 23,700 mark. That will be the crucial one to watch out for after the big decline that we've seen and whether there is another round of selling in the second half of trade. Why do I say that? Because the Nifty Bank, which was earlier outperforming, is now underperforming, down about 1%, and the Midcap index has it a lot worse. The Nifty Bank is the one in focus at around 50,700. Why is that? Because it's Wednesday and it's the last weekly options expiry that we have on the Nifty Bank today. From next week, of course, these weekly options expiries for the Nifty Bank and others would be taken out. And for this expiry, the 50,800 call writers fairly active. We have the 50,700 put writers equally active as well. So that's telling you that around 50,850, we will see a fair amount of a resistance for the Nifty Bank, but at lower levels, 50,700 put, telling you that we have some support at around 50,600. We are also seeing some writing at the 50,600 put, and the 50,500 put itself has the maximum open interest. So 50,500 to 50,600 could be an important support for the Nifty Bank in today's trading session itself. For the Nifty, all these put writers have actually been caught on the wrong side. So serious short covering on the 23,900 put, the 24,000 put as well. A lot were hoping that 24,000 will play out as a support. That's not the case to be. And now we've seen some writing at calls which are higher levels, and even some at the money calls. So 23,800 call writing telling you 23,850 would be some resistance, and at the same time the 23,700 mark where we have a fair amount of tug of war. The 23,700 call has a premium of 100 rupees, seeing some writing, but at the same time we have the 23,700 put, which is also seeing some writing. Together they have a premium of 200 rupees. So those who are selling this straddle of 23,700 call and put together are playing for a range of 23,500 at the lower level on the Nifty to 23,900 on the upper level itself. 23,500 would be an important one to watch out for, because you have the 200-day moving average a little over 23,500 itself. Stocks in focus today. A lot of long positions being unwound on Jubilant Foodworks after a big move that we saw on the upside yesterday. Also, a lot of short covering seen on Trent. Now the stock has begun to move up from the levels that we saw last week at the lower end, and also GNFC is the one which is seeing a fair amount of open interest build up, may enter F&O band with the kind of up move that we've seen in open interest today and the down move that we've seen in the stock today.
Thank you so much for that, Mangalam. We'll keep an eye out for GNFC as well. Let's slip into a short break. Up next, Pranav Bansal, the MD and CEO at Bansal Wire Industries, will join us to discuss the Q2 numbers and the way forward. Welcome back to HTR. Well, as promised, Bansal Wire Industries, which reported a good set of Q2 numbers. The company saw a strong operational performance as margins sustained about 7.5% for the second consecutive quarter. Pranav Bansal, the MD and CEO at Bansal Wire, joins us now to discuss more. Good afternoon, Pranav. Thank you so much for joining us. Well, in Q2, hygiene check. What are the volumes as far as this particular quarter was concerned? Q3, how are volumes looking, and where do you expect to end FY25 in terms of volumes?
Hello, thank you for having me. So in Q2, we did about 80,000 tons of volume in all our three sectors, which is high carbon, low carbon, and stainless steel combined. For Q3 as well, we're looking for a good growth, as we have been doing in the last quarter and the quarter before that, mainly coming from consolidation and us setting up one of the largest facilities of wires in Asia, which is also being operationalized and is set to be fully operational by the year end. So we are looking at good numbers in volume, good growth in volume in quarter 3 as well as quarter 4.
What is the growth? Your installed capacity is close to 320,000 tons per annum. What do you intend to produce and sell this year?
So as far as capacity goes, we are looking at an installed capacity of 6 lakh tons by the end of this year. Therefore, you see some growth coming every year. And our target for the next 2 quarters is also to grow at the same pace as we have been in the last 2 quarters.
Right. Pranav, talk to us about the export contribution as far as H1 FY25 is concerned. Are you witnessing a slowdown there? And even when we look at historical trends in the last 3 years, there appears to be a much lesser contribution of exports as it was, let's say, 2-3 years back. And what is the targeted export contribution by the end of FY25?
well, you're absolutely right. In the last 2 years, our export has not done very well, mainly because of the geopolitical situation. And what you also need to understand here is that 75% of our export comes from only Europe and US, and those two areas have not done well in the last 2 years. Therefore, you see that reduction. Although it has already picked up in the H1, we have done about close to 10% export in Q2 as well. We are looking for good numbers coming in for Q3 as well as Q4. Although our business model is not very dependent on export, it is more of a domestic business model. And even in domestic market, we already have more than 5,000 customers. So we're not really very dependent on one single customer, because we've diversified to a large extent there. But still, export has been a good area for us, and we continue to focus on that.
Could you give us a sense of the expected utilization of your Dadri plant? Like you said, by the end of this year, your installed capacity will go to 6 lakh tons. In the second half, what is the expected utilization there? And if you could also throw some light on the EBITDA per ton in the second quarter, and how do you anticipate that to move over the next couple of quarters?
So as far as EBITDA per ton goes, if you take our sales, which is about 80,000 tons for the quarter, and we did about close to 68-70 crore of EBITDA. So you get the figure right there, right? 8 to 9 rupees a kg is the average blended EBITDA for our products. We are looking at a good volume growth, definitely. In the first 2 quarters itself, we have done good growth as compared to the last year. Same kind of a trend we are looking at for Q3, Q4. And if we follow just the growth that we've done, I would say that we should have at least 10% more every quarter in volumes.
Okay, give us a sense of how do you expect to see sales mix changing. So by the end of FY25, currently we understand low carbon at 57%, high carbon 22%, and the remainder being stainless steel. End of FY25, end of FY26, how do you see this particular mix changing?
So FY25, what we are looking at is more mix coming from low carbon. This is also coming from the consolidation that is happening within the group. Within the last quarter, we have consolidated one of our group companies, which is Bansal Steel Power, which is now a 100% subsidiary of Bansal Wire. In this quarter, we have taken a target to consolidate all sales coming from Balaji and Bansal High Carbon. Therefore, these two companies making only low carbon will come to Bansal Wire within the third quarter and the fourth quarter. So by the end of Q4, we are looking at a good increase from low carbon. High carbon and stainless steel will see a general 5, 7, 10% kind of increase.
All right, quickly before we let you go, Pranav, finance cost has come down slightly from 6.25 crore to 5.5 crore per quarter. What is the likely run rate going here, given that you are intending to be debt-free post your IPO? That's what your stated intention was. And what are the return ratios that you're targeting, both on ROE and ROCE?
So the proceeds from the IPO came to us by end of July. Therefore, you see some contribution coming even in the interest cost within the second quarter. You will see a major change here within Q3 and Q4, because after the proceeds of the IPO, we are already today kind of debt-free.
Well, thank you so much for joining us and throwing some light as far as how exactly you expect H2 to pan out. Well, moving on, we'll slip into a short break. We will get you more on markets and stock-specific action on the other side.
Welcome back. Let's get you an exclusive chat now with the management of NTPC Green as the IPO is launched today. It's a 10,000 crore IPO with an offer for shares in the price range of 102 to 108. Let's hear out.
So there is nothing from the OFS side. So this is a completely fresh issue.
For 10,000 crores.
Yeah, the complete 10,000 crores. So this is the dilution which is happening rather than, so all the new shares will be issued. And this is to meet our capital requirement and further going forward for the transition. As you know that NTPC is the largest power generating company. I'm told every time that whenever there is a power, NTPC just comes instantly in their mind. So similarly, going forward, whenever there will be green power, I think NTPC Green Energy will come to this. And that is what our ambition is. we have already chalked out programs to go up to 60 gigawatt by 2032, and this is what we had declared almost about 2.5 years back. Today, when the storage prices are coming down, we believe that we will be able to achieve that before 2032 rather than waiting up to 2032. So this public offer is to raise only 10,000 crore at present, and depending on the requirement of the capex, and as per the guidelines of the SEBI, we will be required to dilute up to 25% in 3 years.
So what is the plan for the 10,000 crore rupees? How do you plan to use the proceeds from the IPO?
The proceeds of this 10,000 would be essentially for fueling our capital expenditure. It's almost 19 gigawatt in the next 3.5 years. But however, intermittently we may use the proceeds also to retire some of the costly loans temporarily. But broadly speaking, it is meant for a capital expenditure.
So right now, if you could give us a sense of debt to equity and pre and post IPO, what is it now, and post the IPO, what would it look like?
The present debt equity is 1.91, but however, we will be implementing all this with a debt equity ratio of 80-20.
Okay. And
so leveraging 1:4, and so at present we are quite comfortable. But our growth plans are also very aggressive. As of today, we are having only 3.3 gigawatt, means 3,300 megawatt operational, whereas we have more than 11 gigawatt, which is 11,000 megawatt under construction. So we are commissioning 3,000 megawatt in this financial year, means up to March, and 5,000 megawatt in next financial year, and another 8,000 megawatt in FY 26-27. So by FY 27, we should be having 19 gigawatt or 19,000 megawatt.
That was
projects.
actually my next question.
So I know that, and this is the kind of the capex requirement which is going to go forward, and that is the reason Director of Finance just mentioned that it will be temporarily if there is some kind of loan repayment, but going forward we will be requiring more and more capex on that. We are going to play very, very important role in the energy transition. As you know that NTPC supplies almost 1/4 of the electricity to the entire country. We have the pan-India presence. So similarly, NTPC Green Energy will be playing the similar role, that it will be a leading green energy company which will be having footprint almost everywhere. But to start with, what we are doing is that the areas where there is a maximum potential for the solar and wind, we are focusing on that, which is like Gujarat, Rajasthan, Andhra Pradesh, Telangana. These are the states where we started, but going forward we will be going almost across the country wherever there is a potential, whether it's for solar or wind. But more importantly, there is two other important things into that, which is the storage solution, because as you know that solar is only during the daytime when the sun shines. So what happens when there is a sunsets and there is off solar hours? So there is a requirement of the storage solution.
For round the clock?
For, if not the round the clock, at least for the peak requirement. Round the clock is the next thing. So to meet the peak requirement and to have the grid stability during the day when there is excess solar. So it's both, there is a combination of that. So there will be huge capex requirement for the storage solutions. We are working on that also. And going forward, there will be another important segment, which is the fourth segment, which is called the green molecule. And green molecule is green hydrogen and green hydrogen based derivatives. The derivatives are green methanol, green ethanol. Then going forward, there will be sustainable aviation fuel. So those kind of things which will be then taking place. Let me add here that about 10 years back, when the solar started and when the first megawatt was commissioned in Gujarat, there was some apprehension in the minds of the many people that what is going to happen. And today everybody is accepting very well, and everybody has joined this kind of momentum on that. Similarly, going forward, there will be storage solution as well as the green molecule solution, which will be
sure. So you said that in till 2019 the plan is for 19 gigawatts. What does
27.
Till 27.
FY27, we will be having 19 gigawatt commissioned, but that does not mean only 19 gigawatt. There is a work which is going on continuously. And what we intend is that what we had said about the 60 gigawatt by 2032, we should be in a position to commission that before that.
Right.
That's what
But in terms of capex, what does it translate into absolute numbers? How much of
So
capex?
let me give to the Director of Finance exact numbers, but let me give you the kind of some numbers which is kind of ballpark figures what you require for the per megawatt of solar and per megawatt of wind. Our strategy is to have almost 90% of the solar and 10% only wind. As far as the solar is concerned, it takes approximately 5 crore per megawatt. And this also, there is a difference of the AC and DC, but you can say that with a kind of 28-29% CUF, with the capex requirement is around 5 crore per megawatt. And for the wind, it is approximately 8 crore per megawatt. So if you put together, this is going to cross 3 lakh crores, means 3.25 lakh crores for the 60 gigawatt going forward. So that itself is only solar plus the wind. Then there will be a storage component, and then there will be a kind of green molecule component. So it's going, as we go along, our requirement will go on increasing, because we have to go aggressively on this end, and we have to really work towards this transition, the 500 gigawatt by 2030, and which has been announced by the government. We have to play a very important role into that, and further 2070, which is the net zero. So it's put together, our contribution will be quite significant into that.
Well, a very important conversation there with NTPC Green Energy. The IPO opens on November 19th and the implied market cap of close to 91,000 crore. Well, with that, it's a wrap on this edition of Halftime Report. Business Lunch will take all the action ahead.